Got a big one today. We are going to be covering some significant housing market updates that have been in the news already. The point is not to break the news about these different changes. A lot of this has already been pushed through. I've already jumped on the live stream previously, excuse me. But what we're going to be covering is the potential outcome of these proposed changes and ideas. Also, the back end of the opportunity that is there. We don't want to have just doom and gloom and a bunch of hype and fear-based news. We want to cover what opportunities could come from this, especially saying that some of these changes are actually taking place. So we're really focused on the 50-year mortgage idea / proposal. We're also talking about the portable mortgage, if you guys have heard anything about that. We're also talking as well about Fannie Mae dropping credit score requirements and clearing some things up about that, as well as the potential opportunities that can go there. A lot of hype around this stuff. Some of this stuff is overblown, but it is important for us to understand these are new tricks to the same game. We're going to be breaking down the economic outcome of this, the housing market outcome of this, the likely outcome at least. And again, just diving into the potential opportunity for some of us out there to take advantage of some of these changes in the midst of this chaos. So the first thing we're going to dive into is the 50-year mortgage idea. That one's probably getting the most headlines because it seems like a pretty egregious idea. The formal details about this is it's designed to increase affordability by making the monthly payment more affordable by stretching out the term. Significantly higher total cost, of course. We already know the 30-year mortgage leads to paying for the house 2.5 times, sometimes more than that, depending on the circumstances. Going out 50 years, almost doubling the time of the normal standard mortgage is clearly going to have someone paying for the home multiple times over. Slower equity building and higher risk, and market impact, right? So when we talk about slower equity building and higher risk, the formal breakdown of this is homeowners will build equity much slower, taking decades to own a significant portion of their home. This increases the risk of being underwater, owning more than the home is worth, if property values dip, which at some point they inevitably will. Market impact: by increasing the pool of eligible buyers without adding to the housing stock, a 50-year mortgage could drive up competition, consequently home prices, potentially negating the monthly payment benefits. So you stretch the term out, but then the median home price goes up and you're back to square one. But people who are stuck with those loans are paying a hell of a lot more. The portable mortgage is also interesting. So increased mobility. Portable mortgages, which allow homeowners to transfer their existing loan terms and low interest rates to new properties, will primarily benefit current homeowners locked in by low rates. This would likely increase housing inventory as more people would be incentivized to move. Cool, sounds rosy. Selective benefit and price pressures. The benefit would be selective, applying only to those who already have a low rate mortgage, which is more than 60% of the existing home stock right now. Home buyers without this advantage, renters, first-time buyers, would still face current high rates and potentially even higher home prices due to increased competition for portable buyers. Systemic disruptions. Implementing portable mortgages in the U.S. would pose significant logistical and systemic challenges to existing mortgage-backed securities market, potentially leading to investors demand higher interest rates across the board to compensate for the additional risk. So you could end up in a situation where you're incentivizing existing homeowners to be able to, take their existing mortgage, allowing them to free up property that they normally are locked into or stuck in. But then on the flip side, you have all of these domino effects potentially coming that lead to higher prices and a jam in the mortgage system in the housing market anyway. So the proposed changes are not looking very rosy in the greater scheme of things. Dropping credit score requirements. Let's get into this really quickly, and then we're going to get into the context of it. I appreciate y'all coming into the building, leaving a like. Let me know y'all in the building as y'all coming in. So dropping credit score requirements, expanded buyer pool, limited overall impact, focus on affordability barriers, but not really getting to the underlying problem of supply. So in English, what that basically means is removing strict minimum credit score thresholds like Fannie Mae's removal of its 620 minimum would allow for more first-time home buyers and low-income buyers to enter the market. Facts, cool. Limited overall impact. While beneficial for specific individuals, experts suggest this change alone will not have a massive impact on the broader market. lenders will still evaluate other factors like debt to income ratios, require large down payments for higher risk borrowers who may face higher interest rates. So even if, first off, Fannie Mae is not dictating to private lenders if they can still do credit score requirements. That's number one. Number two, lenders are still going to compensate for the risk. So they're going to want more money down, which cash down or cash to close is still one of the biggest issues and barriers to home ownership in the first place. The next thing is they will also have higher interest rates. So that's going to be a problem in it as well. It's going to affect affordability all over again. And then you're focusing on creating more demand by dropping credit score requirements and allowing more borrowers to come into the fray. Cool. But you still have a housing supply issue that really isn't getting nearly as much as attention as the demand side is. So that's the updates that have been proposed and some potential changes that have taken place on top of other changes like adding Vantage into the mix instead of a FICO-dominated lending market and other things that went on earlier this year. The momentum is swinging around the housing market with this administration. They're doing anything and everything to keep prices as high as possible. Not that that's the goal. The goal is to keep the market active and to keep the economic basis around the housing market active. But in essence, you're leading to not only housing prices continuing to stay at the high that they're currently at, but you're leading to a scenario where they're going to be pushed up. Everything I just went over all came to the same conclusion that this can lead to higher prices on mortgages or on homes. So you're going to end up in the same problem with less benefit for the people participating in the housing market. But the reason I put in the title, the new tricks, same game, whenever things get backlogged, whenever the economy gets slumped in any capacity, the powers that be always revert to the same thing in recent generations. Inflate their way out of the situation. If all else fails, throw money at the situation. Or if you have if you're having a housing issue, create a bunch of demand and maybe deal with the supply on the back end. At the end of the day, you have to understand higher housing prices creates more tax revenues for local, state, and federal governments. You have more economic activity around that. And then wealthier people, of course, are generally benefiting off of higher prices directly or indirectly. There's the powers that be, whether conscious or subconscious, are benefiting themselves by keeping housing prices as high as possible, housing activity high as possible, and benefiting from the tax and economic benefits that come along with higher housing prices. So a stagnant housing market drags the economy down and it drags on tax revenue. So there's a lot of incentive for the government. There's a lot of incentive for various portions of the private market to keep prices as high as they can and keep activity as high as they possibly can. For us as the end users, this isn't very attractive because we end up with we're going to end up with tougher loan terms, even though you're trying to make it more accessible for us. It's just going to push that pressure somewhere else. Oh, credit score requirements drop, bring more money to the table, or pay higher interest rates. Okay, portable mortgages sounds good to an extent, but then you turn around and you're like creating synthetic competition for these particular buyers, which leads again back to a housing price spike. 50-year mortgages. I'm going to pay multiple times more for the home. It's going to take me way longer to own it. For a lot of people, if the average median age has gone up to 35 plus to owning a home, which it has in recent years, meaning to say that people are getting into their mid 30s before they own their first home, a 50-year mortgage will propose that people have to live, generally healthily speaking, 80-something years old before they can potentially own their home, after paying for it probably 3 or 4 times over, by the way, if they follow the full 50-year spectrum. So way less benefits than risk in each of the ideas being tossed. But what it teaches us is that the powers that be, the government, the current administration, and everything else behind it is desperate to get activity up in the housing market. They're desperate. They want mortgage rates plummeted right now, which they want the Federal Reserve to drop their rates to start that process. They also have to have inflation stay low, reportedly, in order for mortgage rates to stay down, because there's a connection there. You want to expand out the loan terms for affordability, portable mortgages, drop credit score requirements, add Vantage scoring into the mix because they have easier credit score models than FICO has, generally speaking. All of these things to create demand. And you're doing nothing at the moment to create supply. Okay, so what does that inherently mean? You're looking to spike housing prices. So the opportunity in this on the back end is there will continue to be significant money poured into the government and private sector, mainly banks and lenders, to incentivize demand in the housing market. What that means is there's going to be a significant increase. There's already a lot out there, a lot of people don't know about, for down payment assistance and closing cost assistance. There's going to be a lot of money thrown in these directions to get people involved in the buying process. You're going to be able to find it on a local, state, and federal level. You're also going to be able to find it at financial institutions, actual banks offering mortgages. Because again, both of these parties need people buying homes. They need people buying and selling homes. The other end of this equation is if you happen to be somebody who directly benefits from reduced loan reduced credit score requirements, or some other door opens up for you. What I'm going to recommend is what I've been telling my clients in person: buy financially first. Buy financially first. So work towards house hacking. Work towards buying the fixer-upper, because you need to the housing market we're inheriting now, and the one that they're working their asses off to try to put us in, is going to be a game where you're going to have to create value or create equity in that home as soon as possible, or create cash flow in that home as soon as possible buying it. You can't just buy the pretty, polished, already like all of the value sucked out of the property already. You can't just buy these homes on emotion anymore. If you're smart, you can't buy them on emotion anymore. You have to buy financially first. Buying a perfectly polished home that's already newly built or renovated, you don't have any opportunity to add any kind of value or equity into, and it doesn't produce any cash flow, is going to be a bad idea. This goes back to the potential risk of being upside down. If the market goes sideways or goes down in some way or crashes after all of this crazy activity, you need to go into the home buying it distressed, buying it as a fixer-upper, or buying it cash flowing, or at least bringing in rent revenue to help towards the mortgage. Buying homes that are already pretty pinked and polished, that have no opportunity to add value, no opportunity to generate income, is going to be a bad idea. So use the opportunities of the federal government and the banking system, both desperate to get housing activity up and get rates down and all this. Use this as an opportunity if your goal is to buy, or if you're considering buying, or you're looking for clarity on how you should buy or when you should buy. Use these openings to get into homes that you can create value in immediately. That is the best option for the majority of people looking to buy a home. There's some people out there with very unique situations. You know your situation better than I do. But the general guidance that I can give, or recommendation or consideration, is use these changes, because they're not going to stop. They're not going anywhere. The entire system needs the housing market jump-started. They're going to do whatever they can. So my recommendation, consideration, is use these openings to slither your way in if you're not already on the housing ladder. If you are, consider buying more property. I've been saying that for a long time. And use these openings to get properties you can add value to. Buy the short sales, buy the foreclosures, buy the distressed sellers, buy the estate, the homes that where somebody passed away and it's probate homes, whatever. Buy the home that needs work when you get into it. Buy the home that has 2 to 4 units, or create an additional dwelling unit. Add value early on in the process. Buy financially, then buy off emotion, then buy for the memories. Buy strategic, buy in smart locations to the best of your ability, desirable areas. Buy homes that need work in those areas, or that you can add value to, and immediately grow equity, immediately generate cash flow early in that process. That is the silver lining to what's going to be a crazy ass housing market. It's already been wild since COVID. It is going to get wilder if any of this stuff continues to push through down the pike. And we're only year one into this administration. And more control is going to kick in because the Federal Reserve, Jerome Powell, is coming out of his seat in 2026. And the president gets to appoint the next one. Clearly, he's likely going to pick somebody that's going to do his bidding. So federal funds rates coming down, Federal Reserve rates coming down, inflation staying in a relatively stable place is going to lead to mortgage rates likely dropping. You're going to have that happening while they're taking everything that they can and moving and shifting everything they can in the lending process to open the door to more borrowers. This is going to lead to a real brush in demand, while the housing supply scenario doesn't really change very much because you can't just build a bunch of homes overnight. And we're millions of homes short, last data has suggested. So for those of you who are on the ropes, considering, you know somebody on the ropes and considering, you already own a home, you think about it, should you buy your next or buy more property? This is the best scenario I can give you. Buy distress, buy value adds, buy multifamily property. Best advice I can give, or at least best considerations I can suggest you take on, because these shifts, ideas are proving that if all else fails, inflate away the system, inflate the housing market, inflate the stock market, pump more money in the system, drop requirements, drop rates, pick up activity. That's the answer all the time. We saw it during COVID. We saw it after 2008. How many more times do we need to see this script play out to understand that? Get into assets. It's basic answer. Own real estate, strategic, smart real estate, own stocks, own precious metals where you see fit, own some crypto, or at least have exposure in some form of fashion. Get your hands on assets. The financial system is going to do anything else. It's going to cope inflating itself away. It is not going to cope. It's not going to cope from deflation, meaning prices, constantly dropping down. It's going to inflate itself away. That's the way our government, our power system, our banking system is designed to function. It is the default response in our system, which means that wages will never keep up. I'm not telling you that being an employee is a horrible thing. There's benefits to that. I've been a huge proponent to good, smart use of your job, being smart about, maxing out the benefits of your job, but wages will not keep up. Being a good employee is not going to save you. It's not going to save any of us. Relying on pay raises, relying on us voting, and just relying on the right politician to get in. We've seen this play out enough times to know, ultimately speaking, we're going to have boom and bust cycles, and the answer is going to always be to inflate away until this game stops. So hopefully this made sense and add some value. I'm going to wrap this video up relatively early. It's kind of late for me on this end. And, I just wanted to give a comprehensive breakdown on what changes have been proposed recently and what they look like, what's implemented and hasn't been implemented yet, and what the potential silver lining or opportunities could be. Take advantage of it to the best you can. Credit Cousin, my guy, if we go back to their generation, go back to 3 generations to one home, will change things. Oh, yeah. Yes. Closing out, that is actually a great point. But I haven't proposed that one because specifically our community of people tend to struggle with that. Everybody else seems to have that under their belt. But the idea of shacking up in homes, 2-3 generations deep, having everybody pool their resources together would be a great solution to this problem. But honestly, the way our culture in America is, and especially Black America, we struggle with that one. We struggle. Other people coming into this country, other people that are just first generation into the country, don't have a problem with that. They seem to come in and adapt to that really well. It's a great proposal. But psychologically, it seems to be something that's difficult for Americans, like, generational Americans, and especially Black America. There's a lot of pride and ego around that stuff, unfortunately. I'm all for it. I think it's a smart move, especially when you're trying to build up. But I don't know, my guy. I'm not so sure that everybody's on board with that one. But I appreciate y'all tuning in, the ones of you that caught it live. Leaving your like, leaving your support. Credit Cousin, my guy. Always an honor to have you in the building. I appreciate you. And to all my pioneers catching the replay, make sure you like, comment, share, subscribe, support the video so the video and the channel can continue to support you. I want y'all to leave your comments down below. Get in the description down below if you want to time with me on Instagram. We're slowly growing the platform out there. And other than that, as always, I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.